come on.
Well, I'd like to thank you for the invitation to speak to the Finance Club here at California State University, Chico. My name is Daniel Salas. I own Access Real Estate Lending, and I got into real estate in 1988, and got into finance. I've always been good with numbers. So real estate finance in 96, worked for some big banks, and in 1999 I started Access Real Estate Lending here in Chico, and been doing loans ever since and loving it. Today I'd like to talk about the mortgage credit crisis. Briefly, what led up to it, what's happened after the mortgage credit crisis, what's occurring now, and what we may see in the future. So that's why I'm here to talk to you today. You know, the mortgage credit crisis, as you may all know, was due to the fact that basically investors were relying on appreciation as opposed to really quality loans. So banks were doing loans with hardly any regulation whatsoever, and turning around and selling those loans to investors all over the world who were buying up these mortgage-backed securities so quickly and without much thought that, again, once the real estate bubble did crash, we just had a liquidity crisis on our hands because we were sitting on so many loans that had been kind of pre-sold, and there was nobody had any money to buy them, and it was just this ripple effect. Again, no regulation on these loans. Basically, we had the banks telling the government that, hey, this is a good loan and you're going to buy it. And the government, or Fannie Mae and Freddie Mac, the purchasers, the largest purchasers of these notes, just buying these products, saying, okay, banks, we'll buy it. We believe you. If you want to pinpoint a date, August 7th, 2007, BNP Paribas terminated withdrawals from 3 of their huge hedge funds, citing, quote, a complete evaporation of liquidity. And then things started falling apart from there. What happened after the mortgage credit crisis, or this date, was that Fannie Mae and Freddie Mac, they're called GSEs, which is the government-sponsored enterprises. Fannie Mae is the largest purchaser of real estate loans in the world. Freddie Mac was and still is the second largest purchaser of real estate loans in the world. And they were taken over by the government. And, you know, the goal was to take it in receivership, take control of the books, get it healthy, and then release it back to the private world. And interestingly enough, so far, an announcement yesterday morning was that they were going to combine Fannie Mae and Freddie Mac into one entity. So we'll see what happens there. But had the government not taken these 2 entities into receivership, then and pumped $127 billion into the groups, the housing industry and perhaps markets in general just would have ceased. So there would have been no market. This led to the Housing and Economic Recovery Act of 2008, or HERA. And HERA also led to the Mortgage Disclosure Information Act, or Mortgage Disclosure Improvement Act. And this was finalized on May 8th of 2009, and remember that date, May 8th, because May 9th, 2009 is a significant date that we'll talk about later as well. The act affected all loans on applications taken after July 30th, 2009, and there were 4 areas of concern with MDIA. Upfront fee collection, initial disclosure review, APR, which is annual percentage rate, or basically your interest rate, changes, and then what's called a no requirement to complete clause or statement, which on a few documents with loan applications you'll sign now is just that statement that you are not required to complete this transaction even though you're filling out an application. Basically, all of these steps kind of gave time for the consumer to consume the information that's being provided to them and make a decision with regard to moving forward. This also created the Federal Housing Finance Agency, and FIFA monitors the GSEs, the government-sponsored entities, Fannie and Freddie, and it combined the staffs of these different government departments. It combined the staffs of the Office of Federal Housing Oversight, Enterprise Oversight, OFEA, the Federal Housing Finance Board, and the GSE Mission Office at the Department of Housing and Urban Development, or HUD, okay? So it just, moved it into one entity of the government that could monitor all these activities, which were important. It changed underwriting guidelines. So banks changed how they made decisions on creditworthiness of home applicants, okay? It changed the automated underwriting guidelines. Automated underwriting guidelines, well, basically, I take an application, I pull a credit report, and I merge the information together, throw it on Fannie Mae or Freddie Mac or FHA's website, and the website says, yeah, sure, we'll do that loan, as long as the supporting documentation that you provide supports the information that was put on the application. We started seeing tightening of those automated guidelines. It required us to change our needs checklist. So when I take an application, I say, hey, basically I'm going to need 2 years W-2s, 2 years 1040 tax returns, 2 months or 2 paycheck stubs to cover a full month, 2 bank statements, and I like to say the twos, 2 IDs for a married couple, so it's kind of easier for them to remember. But we started changing that checklist to get letters of explanation on credit inquiries, explaining deposits that exceed 10 or 25, depending on the loan you're doing, % of your scheduled monthly income. And we kind of learned the hard way, because as we sold loans after doing loans, as we sold them to banks, or if we kept the servicing ourselves and underwriting had missed some of this information, we were having to get it later, or we were having to buy the loan back. I'll get into that later also. But so we learned that, okay, we're gonna have to get this information up front. So it changed the checklist that we provided at the beginning of the application to kind of smooth line and expedite the process as we learned when the market changed. It required us to get Social Security verification on every client, so that we can verify that the Social Security numbers being provided to us are in fact their Social Security numbers. Of course, very important. Now the 4506T form is a form that's signed that enables us to get a printout from the IRS, a tax transcript from the IRS, that we have to match with the tax returns, dollar for dollar, line for line. And in the old days, they would take basically 10% of loans and put them into a pool and through a lottery to say, let's run this one, and hope that the numbers matched, and then they were in compliance and could show the government, look, everything's fine and dandy, these are all checking out. Well, now you have to do that with every file. Again, I think it makes sense. This led into, let me explain, second and third underwriting programs and buybacks, which I just kind of mentioned. But when you underwrite a file, as mentioned before, that's where the decision makers for the loan look at income and verify overtime income. If you need it to be used to qualify, look at deposits and where did this money come from. Okay, they moved money from savings to checking in order to buy. All has to be documented. So after you close the loan and the bank says, okay, we're going to hold on to this loan and service it, and the people will make payments to us, or they say, you know what, let's sell this loan to Wells, let's sell this loan to Citibank, let's sell this loan to any of the lenders that buy. And they underwrite it again. And if you're missing anything, you either have to provide it at that time or you're buying back that loan. Not only that, let me give you another example of a third underwriting. So we did what's called a HARP loan, which is mentioned here, the next thing I mentioned here. But a HARP loan is Home Affordable Refinance Program, and it allows people underwater to refinance, to lower their interest rate, to lower their payments, to save their house instead of having so many more foreclosures in the market. So another good thing. We did a HARP loan and sold it to Citibank, sold the loan. Citibank bought the loan. 11 months later, so almost a year later, Citibank goes to sell the loan to Freddie Mac. It was a Freddie Mac HARP loan, because Fannie Mae has a HARP loan and Freddie Mac has a HARP loan. So Freddie Mac underwrote the file for the third time, and HARP has a requirement whereby if you do a refinance, a HARP loan, the client may not get more than $250 back at the close of escrow. So after you do everything and finance and get the new loan, you can get $250, but if you get $251 back, you don't qualify. So we closed this loan and the client got $233 back. Perfect. Well, it wasn't until 11 months later, a year, where Freddie Mac was underwriting the file and noticed that, well, wait a minute. The client got $233 at the close of escrow, but the loan closed and the prepaid interest on the old loan was paid off a little early, so they got a check for $30, putting them over the $250, and this $340,000 HARP loan that we did, we had to buy it back. So that's why you hear it's difficult to get a loan. It's not that it's difficult to get a loan, you just have to document everything and you have to be prepared to provide information perhaps even later. And so if you do that, you learn this information and you get it up front, then you have less hassles. There's also an FHA Streamline refinance. So HARP and FHA Streamline refinance, if your loan closed before May 9th, 2009, then you qualify for HARP or you qualify for this FHA. It's a reduced private mortgage insurance opportunity, which will lower your rate and not increase your private mortgage insurance payment. Private mortgage insurance, just so you know, when you put less than 20% down, generally, private mortgage insurance is required, and it's a monthly calculation. Back in 2009, the monthly calculation was your loan amount times 0.55% divided by 12. That's your monthly mortgage insurance. The new FHA is 1.25%, so it went from 0.55 to 1.25. So anyone trying to refinance was thrown into this, well, why refinance and float my rate down if my mortgage insurance is going up and I'm saving $3 a month and it's costing me X amount of dollars, right? Well, so the government said, okay, again, that magical date, May 9th, 2009, if your loan was insured through FHA, then you may qualify for this special FHA Streamline program. If it was a conventional loan that was sold before May 9th, 2009, then you can do one of these HARP loans. May 4th, 2009, the Home Valuation Code of Conduct laws went into place, HVCC. It created appraisal management companies. Appraisal management companies, in the past we just had appraisers. We said, hey, appraiser, here's another order, do me a favor and appraise this property. Well, now we have to go through an appraisal management company who has a panel of appraisers on their approved panel to do appraisals for whatever AMC we are teamed up with, agreed to work with. It took time to create a good panel. As you can imagine, when it first started, we were having appraisals done from appraisers in Texas. It was so new that interpreting the new laws took time, interpreting who could be on your panel or who should be on your panel or who could be preferred on your panel, and it just took massaging and understanding and obviously a lot of legal interpretations. And so one thing it did do, HVCC, is it prevented unrealistic appraised values, which is something that led to the mortgage credit crisis to begin with, which we talked about earlier. It created the signing of an appraisal acknowledgement form that the buyer has to sign legally 3 days before signing their final loan documents so that they could absorb and agree with the value of their appraisal. Another good thing. Some bad things is that, again, because we were using all of these just untrained appraisers from out of area, California alone saw trillions of dollars of lost revenue, of lost loan opportunities, because these appraisers were basically, from what I could originally see, looking up values on Zillow and appraising it at that value and not doing their homework. So a lot of inadequately trained appraisers obviously were initially hired, and it took time to weed them out. it increased the cost because now you have an appraisal management company that you're paying for the appraisal, and they have to pay the appraisers. The appraisers are doing more work because of all of these laws and getting paid less. So that also created a concern for quality appraisals, which I'm sure a lot of appraisal management companies still have, but ours, we have learned to work with the areas best and keep them on our panel, so that most buyers, real estate agents we work with are pretty confident in the value that's being supported. This also led to another new law or bureau, the Consumer Protection Financial Bureau, which was created in July of 2010. In the past, we had the Federal Reserve Board, which monitored legal disclosure forms. One called the TIL, Truth in Lending, which was part of the Truth in Lending Act, but it was monitored by the Federal Reserve Board. Truth in Lending had your disclosure sheets, and then Housing and Urban Development monitored your good faith estimate, which is also a closing cost disclosure sheet. And so there were different entities with different laws managing different forms. And so the Consumer Protection Financial Bureau came in to work with both of those entities and created President Obama signed the Dodd-Frank Wall Street Reform and Consumer Protection Act. A lot of people love it, a lot of people hate it. There's just like all of this stuff, good and bad with all of it. The act initially created a financial protection bureau that consolidated these two other entities into one place, and they're focused on one goal: watching out for the American consumers in the market for consumer products and services. It created the good thing, created a new good faith estimate. And they're still working on the good faith estimate, but this new good faith estimate was full disclosure, like what is the cost of transferring this property, whether it be the buyers or the sellers. On this form it doesn't matter, but what's the true cost? That's good. Again, full disclosure. It made changes to the Truth in Lending form. It said that if your interest rate changes by, on a fixed rate anyway, 1/8 of 1%, you have to redisclose those changes to the borrower, and the borrower has to acknowledge that they've received those changes and agree with them before you can move on. A good thing. The GFE, good faith estimate, is a guarantee now. Perfect. Well needed in the industry, I think. It changed loan officer compensation, how loan officers are paid. In the old days, you could, a loan officer, an unscrupulous loan officer could say, okay, well, I am going to put you into a negative amortization loan instead of a fixed rate loan because I'm going to make another $3,000 on this loan. So it was happening out there, unfortunately. And so this new law, loan officer compensation, said no matter what loan you put someone in, then you're going to get paid the same compensation. So it made a level playing field, so it didn't matter what loan you put someone in. Another good thing. It created the National Mortgage Licensing System, which most originators, people that originate loans, have to have an NMLS number, so that if they originate that loan and it's sold to a lender and then sold to Fannie Mae or Freddie Mac, then if there's a problem with the loan, they know who originated it, so they know a little more easily who needs to buy that loan back. A great thing it did was change, it made everything transparent. So just like loan officer compensation, it created this transparency of, look, these are your costs, it's a guarantee. These are your choices for interest rates and the costs or credit associated with them. And, take your choice. So like that too, made it much easier. It's not a sale for a loan. It's like, do you understand? These are your options. Which one do you want? Fantastic. They are working on creating one form, so you don't have a TIL and a GFE any longer. We're just going to have one form. They're still working on it. The cons, those were the pros, the good things. Some of the bad things were that the new good faith estimate, all the good things about it, unfortunately they forgot a couple of things. They forgot to put, well, even though these are the costs to transfer the title, this isn't all the buyer's costs. This is the seller's costs too. There's nowhere to put the seller's responsibility for which fees they have. There's nowhere to put Oftentimes we have seller credit. So someone may buy a house $250,000 with 5% down, seller to credit buyer $5,000 worth of closing costs in escrow. Well, on the good faith estimate, there's nowhere to disclose seller credits. Also, one of the biggest things they forgot was the signature spot. So on the new good faith estimate, there's nowhere for the buyer to sign, which creates, you can imagine some of the potential irregularities that some lenders might put people through, unfortunately. It created a lot of consumer confusion because of, what are we paying? You know, we see all these fees, but my goodness, oh, there's a $5,000 credit. Oh, thank God. You know, there's nowhere for them to disclose that. There's good and bad that happened with regard to the broker, okay? In 2004, we became a bank because we saw the writings on the wall. Banks have been trying to get rid of the broker since I got into the industry and well before that. Because the broker did most of the business and brought the banks a lot of business, the banks felt like, well, God, they just wanted to control more and more. They want to control everything, but they, I feel, won this one. You know, because we saw that they were probably going to win this argument, we became a bank. And the disclosure practices with brokers now and bankers or banks are totally different. For example, if I take an application and we're in contract and I email disclosures to a client and they say, hey, got them, we can order the appraisal. If someone, or I still broker, but rarely, you can tell why, but if you take an application and you're a broker, like, not only do you have to disclose to the client, but you have to disclose to the bank so that the bank can disclose to the client, wait for the client to answer the bank so that you may legally order the appraisal and charge for it. So there's just these delays. You know, shopping for a rate. You know, if you're a broker, you have to put, there's all these columns of, well, what if I did this, and what if I did that, and what if you did that, and what if you did this? But a bank doesn't have to do that. So a little unfair, I think. Misleadingly, the broker form makes it look as though, regardless as to whether they're getting a better deal or not, it makes it look as though a broker is charging more for an interest rate than a bank, even though they may or may not be. Unfair. It created these, what I like to call pseudo lenders. So we became a bank. We have our own warehouse lines with a number of different banks, and we also sell directly to Fannie Mae, Freddie Mac, and we're a direct FHA lender too. So a lot of the qualities that I think are important to get you through the future, we already have. A lot of brokers just signed up with one bank and said, let's make a relationship so that we don't have to wait for disclosure, so that we can order the appraisals immediately, so that, you know. And I don't think that's giving the consumer the options that the consumer deserves to be in these pseudo relationship type of structures, but it works for some people. So what do we see in the future? Well, we see more regulation, we see more compliance, regulatory and legal concerns, and in those arenas it will create much higher cost, particularly in the legal arena for all of these things, compliance, etc. So managing that disclosure concern we see as being pretty important in the future, and potentially creating pools of brokers to try to team up. Similarly to what I did back in '96, I joined a partnership of brokers that we created this partnership, which in turn became a bank. But we see more of that happening just because of the cost of defending yourselves and watching all of that disclosure very closely. Non-agency investors, so not Fannie Mae, not Freddie Mac, or not FHA, you know, particularly now with values starting to climb a little bit as opposed to decline that we've experienced the past few years. You know, Wall Street's interested in investing more in doing loans in the real estate world, and so their delivery fees could be cheaper, which could be a little bit some more flexible underwriting guidelines, as well as a little less expensive to deliver. Now, the rates they might offer might be similar to Fannie Mae, Freddie Mac, but then the delivery fees from us to them as an investor could be less. So just more options potentially for buyers. You know, with Bank of America, MetLife, getting out of wholesale or working with brokers and correspondent like we do. We have warehouse lines of credit with all these banks to fund loans to them and sell them to them. And Wells Fargo getting out of the wholesale arena, working with brokers. We think that, first of all, being prepared for being able to sell directly to Fannie Mae, directly to Freddie Mac, and a direct HUD lender, all of these that we have, as well as these non-agency relationships, are going to be important in the future. Servicing loans, like I said, we service some of our loans. So the ability to sell directly to these entities is going to be very important. The future also, there's a lot of talk about the QM, or qualified mortgage. And in essence, we already have these qualification guidelines that borrowers need to meet, but the government wants to see even tighter regulations. And they want to limit, just like loan officer compensation, they want to limit what banks may make on loans too. So, in the future, we're going to see that's being kind of hashed out currently, and they're discussing the qualified mortgage, which could make loans more expensive for the consumer. Potentially, we think as well. Qualified mortgage is concerned with, now these are good things, of course, no excess upfront points and fees, no toxic loan features. So things like NAGAM loans, things like ARMs that adjust too frequently or are allowed to adjust too much when they do adjust, things like that. Limits on debt to income ratios, so percentages of income that are allowed to go towards housing and other monthly obligations. Let's say someone makes $1,000 a month. Right now, basically $550 a month can go toward housing, or 55% on some loans. The government wants to limit that to $430, or 43% of their income. So it could be good or bad depending on the circumstances. But what's funny, what's not being considered in this qualified mortgage are credit risk scores, which is one of the most important factors with regard to monitoring credit and who is worthy of receiving the best interest rates. Usually the better or higher your credit risk score is, the lower or better your interest rate is, and that makes sense as well, but that's not being considered. So there's a lot of things obviously that still need to be worked out. A lot of things are being discussed, and we'll see what the future does hold in store. I also see more loan officer compensation changes in the future, whether it be the structure or whether they're going to put a limit insofar as what loan officers will be able to make when originating a loan. We don't know that, but we see some changes, and there's already some discussion with regard to that as well. After the mortgage credit crisis, I just kind of like to end this with this statement, John Steinbeck, talking about the problem of poor Americans. The problem with poor Americans is that they don't believe they're poor, rather temporarily embarrassed millionaires. Thanks a lot for having me today, and we were going to do some question and answers. Any question and answer opportunities?